former Donald Trump advisor, Omarosa Manigault Newman. She was a contestant on the first season of The Apprentice. She's also the author of Unhinged, an insider's account of the Trump White House. Omarosa, thanks for joining us tonight. You've seen the headlines.
Thanks for having me, Abby.
30 underwriters have said no to Donald Trump when he went to them and asked for help to cover this $500 million bond. For decades, banks have been willing to lend to Trump for all kinds of reasons during all kinds of financial distress. Why not now?
Well, it's very simple, Abby. They don't trust him, and they don't believe that he'll pay them back. The other part of it is that Donald Trump has, for so many years, run a scheme, and he's built his business on deceit and a house of cards. And as we can see, that house of cards is now going to collapse.
30. That's the number I want you to keep in your head for the next 20 minutes. Not as an abstraction, not as a rhetorical device, as a documented fact with a specific meaning.
So one of Trump's attorneys, Alina Habba, she promised over and over again that Trump would be able to cover everything, even as recently as last month. Listen.
Does Donald Trump have that kind of money sitting around?
Yes. I mean, he does. Of course, he has money. You know, he's a billionaire. We know that.
This guy is worth a lot of money, billions and billions of billions of dollars. He happens to have a lot of cash.
Of course he has the money. Why would she lie like that so boldly and seemingly without any sort of, self-awareness?
Well, the truth of the matter is, if Donald Trump had the money, he would not be asking for special favors from the judge.
Let me tell you what that statement was. It was not a financial disclosure. It was not a representation made under oath. It was not a document submitted to a lender or an insurer or a court. It was a television performance. And I mean that in a precise analytical sense, not as an insult to Alina Habba's legal competence, but as an accurate description of the specific function that statement served in the Trump communication strategy. Habba was Trump's personal attorney and public spokesperson during the most legally exposed period of his life outside of the criminal cases. She appeared on television regularly, and her television appearances served a dual audience simultaneously. The first audience was the general public watching CNN. The message to that audience: don't panic, this is fine. Trump has the resources to handle this. The bond crisis is a political attack, not a genuine financial emergency. The second audience was Trump himself. Trump watches television obsessively. His legal team knew this. A lawyer who went on CNN and said honestly, "We cannot find a single company willing to back this bond, and we may lose Mar-a-Lago to Letitia James," would not remain Trump's lawyer. The performance of confidence was also a performance of loyalty. And in the Trump ecosystem, loyalty is the primary currency. The 30 insurance companies were not watching Habba's television appearances. They were looking at documents, running actuarial models, assessing collateral, reviewing the trial record from Judge Engoron's court. And what they found was not billions and billions in liquid cash. What they found was a portfolio of real estate properties whose valuations had just been determined after a full trial with expert witnesses and testimony from Trump's own executives to be systematically and materially inflated. The gap between what Habba was saying on television and what 30 separate professional risk assessors were concluding in their due diligence is the gap between the performance and the documented reality. Now let me build the full factual timeline because the numbers here matter, and I want to be precise about each one. Parte A, o julgamento, a fiança, e os 30 nãos. The judgment in the New York civil fraud case was entered by Judge Arthur Engoron on February 23, 2024. The total, $464,576,230.62. That number breaks down into two components. The first is $354.8 million, the disgorgement of benefits Trump received through a decade of fraudulent financial statements submitted to banks and insurance companies. The second is approximately $100 million in interest, accumulated at the mandatory 9% annual rate on New York civil judgments from the time the fraudulent conduct was established. By the date the judgment was entered, the interest component was growing at approximately $87,502 per day. Every day the appeal proceeded without a posted bond, the number got larger. To appeal the judgment, to prevent Letitia James from immediately moving to collect, Trump needed to post a bond. The bond is a guarantee. If Trump lost the appeal, the money would still be available to collect. Standard appellate procedure. The bond company stands behind the guarantee, and Trump posts collateral. For a bond of this size, the collateral is typically cash. Trump's legal team went to 30 insurance companies. Every single one said no. Understanding why requires understanding what those companies were actually looking at. They weren't evaluating Trump's public claims about his wealth. They were evaluating his actual documented assets as potential collateral. And here's the specific problem those 30 companies encountered. The most substantial assets in Trump's portfolio were real estate properties. And those properties had just been examined by a New York trial court, with expert appraisers, with forensic accountants, with testimony from Trump's own executives, and found to be worth dramatically less than what Trump's financial statements claimed. The fraud wasn't just a legal finding. It was a collateral problem. The same inflated valuations that produced the $354.8 million judgment made the real estate worthless as bond collateral. If the properties were worth what Trump claimed, they could theoretically serve as security. But a court had just found they weren't worth what Trump claimed. The scheme was consuming itself. The fraud that built the financial statements was the same fraud that destroyed the collateral value when actual scrutiny was applied. Some of the 30 companies apparently had a second concern beyond collateral quality. They didn't believe Trump would pay the judgment even if he lost the appeal. That's a separate actuarial calculation, an assessment of character and reliability as a debtor, not just asset quality. Omarosa identified both concerns precisely. They don't trust him to pay, and the assets aren't worth what he claims. Both concerns, independently, were sufficient to produce a no. 30 companies reached that conclusion through their own processes. 30 simultaneous no's. With 30 rejections and a $464 million deadline approaching, Trump's lawyers went to court. They asked the appellate division to either stay the judgment entirely pending appeal or reduce the bond requirement. Their requested reduction, down to $100 million, less than a quarter of the $464 million owed. The argument was explicit. Posting $464 million in cash is impossible. Judge Engoron's response to the request for a stay was terse and pointed. He sent Trump's lawyers an email stating directly that they had failed to explain, much less justify, any basis for a stay, and expressed confidence that the appellate division would protect their appellate rights through proper channels. On March 25, 2024, the appellate division intervened. They did not grant everything Trump wanted. They reduced the bond requirement from $464 million to $175 million and gave Trump 10 days to post it. The same day the reduced amount was announced, Trump posted the bond through Knight Specialty Insurance Company, a California-based insurer whose chairman has been described as a subprime specialist in the insurance industry. The bond was cash collateralized, meaning Trump gave Knight Specialty actual cash as security. Now here is the financial fact that the entire bond crisis reduces to. Trump could post $175 million in cash on the same day he received the reduced requirement. He could not find a single company willing to back $464 million. The gap between $175 million possible and $464 million impossible is the most accurate available measurement of Trump's actual liquid asset position as assessed by 30 independent professional risk evaluators. It is not a political number. It is not a judicial opinion. It is the market's verdict, rendered simultaneously by 30 separate institutions doing their jobs. Haba said $500 million in cash, citing Trump's own Truth Social posts. The market said $175 million maybe, with a specialized insurer whose normal business is high-risk underwriting. That gap, between the claim number and the demonstrated number, is what Omarosa was describing when she said House of Cards. I want to spend a moment on the underlying fraud mechanism, because I think people hear the $354.8 million figure and sometimes don't fully grasp what conduct produced it. The New York civil fraud case was brought by Attorney General Letitia James under New York Executive Law Section 63-12. The allegation, subsequently proven at trial, was that Trump had systematically submitted inflated financial statements to banks and insurance companies, claiming his properties were worth dramatically more than their actual market value, in order to obtain better loan terms and lower insurance premiums. The trial produced specific documented examples. Mar-a-Lago, Trump's Florida estate and primary residence, valued at $426 million on Trump's financial statements submitted to lenders. Independent appraisers at trial, $18 to $27 million. That is not an aggressive but defensible valuation methodology. That is not a difference of opinion between two qualified appraisers using different assumptions. That is a 16-to-1 ratio between the claimed value and the independently assessed value. Trump was telling lenders his property was worth 16 times what it was actually worth in order to borrow money against it. The $354.8 million disgorgement figure represents the calculated benefit Trump received through those inflated valuations across a decade of transactions with multiple lenders and insurers. The better loan rates, the lower insurance premiums, the access to credit that accurate financial statements would not have produced. Compounded across 10 years of transactions. The legal theory is precise. Give back what you gained through fraud. An important nuance worth understanding. Nobody lost money on Trump's loans in the conventional sense. The banks got repaid. But New York law does not require a victim with a documented dollar loss to establish civil fraud. Lying to get a better deal is fraud, and the competitive harm extends beyond the direct transaction. An honest borrower who submitted accurate financial statements paid higher rates than Trump did because they weren't inflating their net worth. The playing field was tilted against every competitor who followed the rules. The $354.8 million was the measure of that tilt, quantified across a decade. The bond crisis becomes more legible when you understand Trump's banking history, specifically his relationship with Deutsche Bank. That relationship ran for nearly 20 years, from the late 1990s through January 2021, when Deutsche Bank cut ties following the events of January 6th. During that period, Deutsche was Trump's primary institutional lender. Critically, Deutsche was the only major Western bank willing to maintain a lending relationship with Trump after his Atlantic City casino bankruptcies in the 1990s destroyed his relationships with American banks. Deutsche Bank kept lending for a specific reason. Trump kept showing them financial statements claiming his properties were worth enormous amounts, and Deutsche kept accepting those statements as the basis for extending credit. The New York civil fraud case is the legal documentation of what Deutsche Bank had been tolerating for 2 decades: the systematic inflation of asset values to secure better loan terms. The numbers that a court later found were fabricated were the same numbers Deutsche had been accepting for 20 years. When Deutsche cut ties in January 2021, Trump's access to major institutional lending effectively disappeared. He no longer had a 20-year relationship with a bank whose institutional incentives had historically overridden rigorous risk assessment. When the bond crisis arrived in February and March of 2024, Trump went to 30 insurance companies who had no prior relationship with him. No 20 years of institutional history. No existing credit relationship creating incentives to maintain the connection. No reason to extend anything other than pure actuarial judgment. They did in one due diligence process what Deutsche Bank had not done in 2 decades. They looked at the actual asset values, not the stated ones, the actual ones, and they reached the same conclusion that the trial court had already reached. The properties weren't worth what the financial statements claimed. The inflated valuations that had worked on Deutsche Bank for 20 years failed 30 separate risk assessments by institutions with no prior relationship and no incentive to extend anything other than an accurate professional judgment. In 2004, Donald Trump began hosting The Apprentice. For 14 seasons, He sat at the head of a boardroom table and performed the role of the ultimate business authority, the man who could evaluate talent, identify weakness, and deliver the definitive verdict on financial and personal judgment. You're fired. The show was the foundation of the billionaire genius brand that eventually became the presidential brand. It rebuilt Trump's public image after the casino bankruptcies, generated significant brand licensing revenue, and created the cultural identity he deployed to win the 2016 presidency. The show ran concurrently with the fraudulent financial statements being submitted to banks and insurance companies. You're a billionaire, and a financial genius was the premise of The Apprentice. He's built his business on deceit, and the House of Cards was Omarosa's counter-assessment from someone who had been on that show, who had observed how the production worked, who had seen the gap between the brand and the substance from the inside. The 30 insurance companies reviewed the actual documents rather than watching The Apprentice. They reached Omarosa's conclusion rather than Haba's. The civil fraud trial was the first major institutional examination of the actual business. Not the branded version, but the real documents. The actual financial statements submitted to actual banks, with expert testimony about what the properties were actually worth. And it found, consistently and specifically, what Omarosa says she observed from the inside: the gap between the performance and the reality. For decades, that gap was manageable because nobody looked too hard. Deutsche Bank lent money based on financial statements that claimed properties were worth enormous amounts. Insurance companies wrote policies against those same numbers. The branded businessman image projected through The Apprentice provided a cultural context that made the claimed valuations feel plausible without requiring documentation. Nobody looked too hard for a very long time. Letitia James looked hard. Judge Engerin looked hard. 30 insurance companies looked hard when asked to back a $500 million bond. They all found the same thing. I want to close the analytical section with what I consider the most revealing element of this entire story. What happened to Alina Habba after she said billions and billions on television, while 30 companies simultaneously said no? She was rewarded. After Trump won the 2024 presidential election, Habba was appointed counselor to the president and senior White House advisor, one of Trump's most trusted loyalists in the administration. The woman who said, of course he has the money, while 30 insurance companies concluded he could not cover a $464 million bond, is now a senior official in the executive branch of the United States government. This is not an accident or an irony. It is the Trump ecosystem functioning as designed. Omarosa described the design. He's built his business on deceit. What she was identifying, more precisely, is that the currency of the Trump operation is not accuracy. It is the performance of loyalty. It is the public, confident, maximum volume assertion of Trump's greatness, wealth, and victimhood, regardless of whether those assertions survive contact with documentation. Habba performed confidence loudly and repeatedly in the face of 30 simultaneous professional rejections. She said billions when the market said 175. She maintained the performance without visible hesitation. She got the job in the White House. Omarosa said House of Cards. She was telling the truth as she understood it from years of inside observation. She did not get a job in the White House. She was fired in 2017. The pattern is not complicated. Accuracy in the Trump ecosystem is not a path to advancement. The performance of confidence and loyalty is. Habba was not lying in the conventional sense. She was not making a financial representation she knew to be false in a context where documentation would be required. She was performing the Trump world's articles of faith. Trump is rich. Trump is successful. Trump has billions. These are not financial claims subject to actuarial review within that ecosystem. They are the foundational premises that the operation requires its participants to perform, publicly and loudly, at all times. The 30 insurance companies subjected those premises to actuarial review. The ecosystem's articles of faith and the market's professional risk assessment reached irreconcilable conclusions. Here's where the record stands as of 2026. The bond crisis was resolved at $175 million, a number that tells you more about Trump's actual liquid asset position than any public statement he or his lawyers ever made. The appellate division reviewed the $354.8 million disgorgement penalty on the merits and found it violated the Eighth Amendment's prohibition on excessive fines. The dollar amount was vacated. That was a genuine legal victory on the remedy. But here's what every judge on that appellate panel, including the one who would have dismissed the entire case, acknowledged in their written opinions. The fraud happened. The trial record established fraudulent conduct. The debate was only about the appropriate penalty for that conduct, not about whether the conduct occurred. The fraud finding is confirmed. It is in the permanent legal record. It will be cited, analyzed, and built upon regardless of what the courts ultimately decide about the penalty amount. Letitia James has appealed the penalty reduction to New York's highest court. That appeal was pending as of early 2026. The fraud, confirmed by every reviewing judge, permanent. The penalty currently reduced, under appeal. The 30 no's, documented. The $175 million versus $500 million claimed, documented. The Deutsche Bank 20-year relationship with inflated valuations, documented. The gap between The Apprentice and the trial record, documented. Omarosa called it House of Cards in a television interview. 30 professional risk assessors, working independently, reached the same structural conclusion through actuarial analysis. The house didn't fully collapse, but the cards are visible now. And billions and billions and billions is a harder claim to sustain in public after 30 companies, one trial court, and an appellate division panel reviewing a complete evidentiary record all came to the same conclusion about the gap between the stated numbers and the actual ones. Here's the question I want to leave you with. And I'm genuinely curious about your answer on this one. The Deutsche Bank relationship ran for 20 years. 30 insurance companies reached a conclusion in one due diligence cycle that Deutsche apparently never reached in 2 decades. There's a reasonable argument that Deutsche's institutional incentives, the existing relationship, the lending revenue, the history, created a structural disincentive to look too hard at the actual numbers. My question is this: what does it tell us about institutional risk assessment, in banking, in media, in politics, when the parties with the longest and closest relationships to a subject are consistently the last ones to see what 30 strangers with no prior relationship see immediately when they look at the documentation? That's not a rhetorical question. I think the answer has implications that go well beyond this specific case. Drop your analysis below. This is William Carter. I'll see you in the next one.